Four crises are hitting the world at once, and the Federal Reserve has no way to stop what's coming. March 2026 could be the month everything collapses. Are you ready? March 2026 could be remembered as the month the world's economy finally broke. For massive crises are colliding at the same time, and the Federal Reserve may have no way to stop the collapse. Debt is exploding, global trade is failing, currencies are wobbling, and trust in money is vanishing. If you think this is just another recession, think again. Stay with me, because in this video, I'll reveal exactly what's happening, why it's worse than anyone expects, and what could happen next before it's too late. Something strange is happening right now, and almost no one is talking about it the way they should. March 2026 is not just another moment in the economy, it's a pressure point, a breaking point, and the scary part. It's not just one problem building up behind the scenes, it's four separate crises, all hitting at the same time. Now here's where it gets serious. Normally, when the economy faces trouble, there's a safety net, a system designed to step in and calm things down. That system is the Federal Reserve. For decades, this institution has acted like the ultimate firefighter. Markets crash, they print money, inflation rises, they raise interest rates, banks fail, they step in and stabilize the system. But what if I told you this time is different? This time, the tools they've always relied on might not work anymore. And that's not speculation. That's the real fear quietly spreading among economists, insiders, and investors who are watching the signals closely. Because here's the truth, no one wants to say out loud. The system isn't built to handle multiple crises at once. It's built to handle one. Think about it like this. Imagine a building designed to survive earthquakes. It has strong foundations, flexible structures, and emergency systems. It can take a hit, maybe even a big one. But what happens if, at the same time, there's an earthquake, a fire, a flood, and a power outage? The system doesn't just get stressed, it gets overwhelmed. That's exactly where we are right now. Crisis number one is quietly shaking the financial system from the inside. Crisis number two is hitting global trade and supply chains. Crisis number three is attacking currencies and trust in money itself. And crisis number four is something most people haven't even noticed yet. Each one alone would be dangerous. Together, they're explosive. And the worst part, they're not happening one after another. They're happening all at once. This creates something economists fear the most, a chain reaction. One crisis feeds into another. One failure triggers the next. And suddenly, what looked like a slowdown turns into a full-scale collapse. But here's where things get even more uncomfortable. The Federal Reserve has already used most of its strongest tools over the past few years. Interest rates have been pushed up, then held high. Money printing has already been used on a massive scale. Debt levels, already at historic highs. So when the next shock hits, what's left? That's the question no one has a clear answer to. Because the usual playbook might not just fail, it might make things worse. Lowering rates too fast could trigger inflation again. Printing more money could destroy confidence in the currency. Doing nothing could let the system spiral. It's like being stuck in a room where every exit leads to another problem. And this is why March 2026 feels different. It's not just about recession fears. It's not just about inflation or market corrections. It's about the possibility that the system itself is reaching its limits. Now you might be thinking, haven't we seen crises before? Yes, many times. But here's the key difference. In the past, crises were isolated. One sector would crash, and others would absorb the shock. The system had balance. Today, everything is connected. Banks, governments, markets, currencies, all tied together in ways that make separation almost impossible. So when pressure builds in one area, it doesn't stay there. It spreads fast. And that's exactly what we're starting to see right now. Small cracks are forming. Subtle signals are appearing. Movements that don't make sense on the surface, but point to something deeper, something bigger, something that most people will only recognize when it's already too late. And as we move forward, you'll start to see exactly what those four crises are, how they connect, and why they're creating a situation that even the most powerful financial system in the world might not be able to control. Because the first crisis is already underway, and it's more dangerous than it looks. The first crack in the system isn't loud. It doesn't show up as breaking news. It doesn't feel like a crisis at first. It looks normal. Governments borrowing money, markets moving up and down, interest rates rising and falling. But underneath that normal surface, something is completely out of control. Debt. Right now, the global economy is sitting on a mountain of debt so massive that it's almost hard to understand. Governments owe trillions. Corporations owe trillions. Even households are stretched thin. And for years, this didn't seem like a problem. Why? Because borrowing was cheap. When interest rates were low, debt felt easy to manage. Could take loans, refinance them, roll them over, and keep the system moving. It was like living on a credit card, but never feeling the pressure because the minimum payment stayed small. But that has changed. And this is where the real danger begins. The Federal Reserve, in its fight against inflation, pushed interest rates higher. It's much higher than what the system had gotten used to. At first, it looked like the right move. Inflation slowed down, markets adjusted. Everything seemed under control. But here's what most people didn't realize. Raising interest rates doesn't just slow inflation, it also makes debt more expensive. And when you have a system drowning in debt, even a small increase in rates can turn into a massive problem. Now imagine this. You took a loan when interest rates were low. Your payments were manageable. Life was fine. But now suddenly, those rates have doubled, or even tripled. Your payments shoot up, your margin disappears. And now, instead of growing, you're just trying to survive. This is exactly what's happening right now. But on a global scale, governments are now spending more just to pay interest on their existing debt. Companies that relied on cheap loans are starting to feel the pressure. Even banks are becoming more cautious because they know what's coming. This creates a silent squeeze. Less spending, less investment, less growth. And here's where it gets dangerous. When growth slows, but debt payments rise, something has to give. Either the system keeps borrowing more to stay alive, or it starts breaking. This is what economists call a debt trap. And once you're in it, getting out is almost impossible. Just think about the options. Option 1, lower interest rates. That would make debt easier to manage again. Sounds good, right? But there's a problem. Lowering rates too quickly could bring inflation roaring back. Prices could surge again, destroying purchasing power and confidence. Option 2, keep rates high. That controls inflation, but it crushes borrowers. Businesses fail, governments struggle. The economy slows down even more. Option 3, print more money. This is what central banks have done in the past, flood the system with liquidity and keep everything moving. But now, doing that again could destroy trust in the currency itself. And once trust is gone, everything changes. So no matter which path is taken, there's a cost. And none of those costs are small. This is why the Federal Reserve is in such a difficult position right now. Every move they make solves one problem, but creates another. It's like trying to fix a leaking pipe, only to realize the entire system is corroded. And this is just the first crisis, because debt doesn't exist in isolation. It connects to everything else. When governments struggle with debt, they cut spending or raise taxes. That slows the economy. When companies struggle with debt, they cut jobs or reduce expansion. That increases unemployment. When banks see rising risk, they tighten lending. That chokes off growth even more. It becomes a cycle, a loop that feeds on itself. And once that loop starts, it's very hard to stop. But here's the part most people don't see coming. This debt crisis doesn't just stay in financial systems. It spills over into markets, into currencies, into everyday life. And when it does, it triggers the next crisis. A crisis that moves faster, spreads wider, and hits harder than anything we've talked about so far. Because while the system is struggling to manage its debt, something else is already starting to break. While everyone is focused on debt and interest rates, something else is quietly falling apart in the background. And this one moves faster than people expect. Global trade. For years, the world economy depended on one simple idea. Everything is connected. Countries produce what they're best at, ship it across the world, and everyone benefits. Cheap goods, stable supply, predictable prices. It worked so well that most people stopped thinking about it, but now that system is starting to crack. The signs are already there. Shipping routes are becoming unstable. Costs are rising again. Delays are creeping back into supply chains. And countries are slowly pulling back from global cooperation. At first, these look like small issues, temporary disruptions, things that will fix themselves over time. But they're not random. They're connected. And they're building toward something much bigger. Because global trade doesn't break all at once. It weakens step by step. Until one day, the system can't hold together anymore. Let's break it down in a simple way. Imagine a factory that depends on parts from 5 different countries. If even one of those suppliers fails, the entire production line slows down. Now scale that idea up to the entire world. That's what we're dealing with. And right now, multiple weak points are appearing at the same time. Geopolitical tensions are rising. Countries are becoming more protective of their own resources. Trade restrictions are increasing, and trust between major economies is starting to fade. This creates friction. Friction in global trade leads to one thing: higher costs. Goods become more expensive to produce, more expensive to ship, more expensive to buy, and that feeds directly into inflation. But here's where things get even more serious. When trade slows down, it doesn't just raise prices. It reduces availability. Products take longer to arrive. Some disappear completely. Businesses struggle to keep up with demand. Suddenly, what used to be normal becomes uncertain. This is how supply shocks begin. And supply shocks are dangerous because they hit fast, faster than debt problems, faster than policy changes. They show up in real life almost immediately. Empty shelves, rising prices, delayed deliveries. People feel it. And when people feel it, panic starts to build. Now connect this back to what we talked about in the last chapter. The system is already under pressure from rising debt costs. Now add trade disruption on top of that. Businesses are paying more for goods, while also paying more on their loans. Margins shrink. Profits disappear. And eventually, some companies don't survive. This leads to layoffs, reduced production, and even more strain on the economy. It becomes a chain reaction. And here's the part most people miss. Global trade isn't just about goods. It's also about trust. Countries need to trust each other to keep the system running, to honor agreements, to maintain stable flows of resources. But right now, that trust is weakening. And when trust breaks down, systems don't just slow down, they fragment. Countries start building their own supply chains. They rely less on others. They protect their own interests first. On the surface, that might sound like a smart move, but globally, it creates inefficiency, higher costs, slower growth, more instability. This is called deglobalization, and once it starts, it's very hard to reverse. Because every country begins to act in its own interest, even if it hurts the system as a whole. Now think about what that means. A world where trade is slower, more expensive, and less reliable. A world where supply shocks are more frequent. A world where economic coordination is weaker. That's not just a temporary problem, it's a structural shift. When that shift happens at the same time as a debt crisis, the pressure multiplies. But we're still not at the worst part, because there's another layer to this. It's a deeper issue that sits underneath both debt and trade, something that holds the entire system together, and right now, that foundation is starting to shake. Because when people begin to lose trust, not just in trade, not just in markets, but in money itself, that's when things change completely. Up until now, everything we've talked about, debt, trade, rising costs, still operates under one hidden assumption, that money works, that when you earn it, save it, or spend it, it holds value, that the numbers in your bank account actually mean something real. But what happens when that belief starts to break? Because this is where things stop being just an economic problem, start becoming a system-wide crisis. Money is not just paper. It's not just digital numbers on a screen. It's trust. Trust that your currency will hold value tomorrow. Trust that prices won't suddenly spiral out of control. Trust that the system managing all of this knows what it's doing. And right now, that trust is starting to crack. Slowly at first, then all at once. Let's go back to the role of the Federal Reserve. For years, it has been the backbone of confidence. When things got bad, People believed the system could step in and fix it. That stability would return. But now, the situation is different, because the tools that used to build confidence are now creating doubt. Think about it. If the Federal Reserve raises interest rates, it puts pressure on debt and slows the economy. If it lowers them, it risks inflation coming back stronger. If it prints more money, it injects liquidity. But also raises a dangerous question. How much is too much? At what point does money lose its meaning? This is where psychology takes over. The value of money isn't just based on policy, it's based on belief. Once people begin to question that belief, everything starts to change. You see it in small ways at first. People start moving their money into assets. Gold, real estate, anything that feels more real than currency. Investors begin to hedge against instability. They don't trust long-term positions the same way anymore. Currencies start to fluctuate more than usual, not because of a single event, but because of growing uncertainty. And then something bigger happens. Volatility increases. Markets stop behaving logically. Price movements become sharper, faster, and harder to predict because confidence is fading. Now here's where it becomes dangerous. When trust in money weakens, it doesn't stay contained. It spreads. It affects how people spend, how businesses invest, how governments operate. If people think money will lose value, they spend faster. That pushes prices higher. If businesses don't trust stability, they hold back. That slows growth. If investors feel uncertain, they move capital quickly. That creates instability in markets. It becomes a feedback loop. And once that loop starts, it feeds on itself. This is how currency crises begin, not with a sudden collapse, but with a shift in perception, slow realization that something isn't right. And when enough people feel it at the same time, this shift accelerates. Now connect this to everything else. The system is already under pressure from debt. Global trade is already weakening, and now trust in money itself is starting to fade. That's 3 crises, all interacting with each other, each one making the others worse. And this is exactly why the current situation is so fragile. Because the system depends on confidence to hold everything together. Remove that confidence, and the structure doesn't just weaken, it starts to fall apart. But there's still one more piece. One final crisis that ties everything together. And this one doesn't build slowly. It hits suddenly. It's the trigger. The moment where everything we've talked about moves from risk to reality. Because when that final shock hits, the system doesn't get time to adjust. It reacts. And that reaction is what turns pressure into collapse.
Wow.
Now we've arrived at the moment most people won't see coming. The first 4 crises, debt, trade, interest rates, and trust in money, have already weakened the system. They've stretched it to its limits. But there's one final element that will push it over the edge. The spark that can ignite a chain reaction nobody can control. This 5th crisis isn't theoretical. It's real. It's already building beneath the surface, quietly, while most people continue their normal routines, thinking the economy will just keep moving along. But systems under pressure don't behave normally for long. Once the trigger hits, the consequences are immediate and unstoppable. So what is it? It's a combination of financial shocks hitting simultaneously across markets, currencies, and banking institutions, combined with policy paralysis at the highest levels. Imagine a scenario where major banks start seeing withdrawals spike. Investors panic, currencies wobble, stocks crash. The Federal Reserve, despite all its experience and tools, cannot intervene effectively because every conventional measure raising rates, lowering rates, printing money is either too late or counterproductive. The first signs appear small. Maybe it's a sharp drop in the stock market in a single day. Maybe a major corporation announces bankruptcy, sending ripple effects through the supply chain. Maybe a key export country suddenly restricts shipments due to political instability. These events alone wouldn't be catastrophic. But combined with the other crises, they create a perfect storm. This is the danger of interconnected systems. Failures amplify each other. Debt pressures trigger defaults. Trade disruptions increase costs for companies already struggling with high interest payments. Loss of confidence in currency pushes people toward alternative assets, draining liquidity. And every misstep feeds panic, creating a feedback loop that escalates faster than anyone can respond. What makes this situation unprecedented is timing. Never before have four major economic stressors converged all at once. Just as the underlying financial system is stretched to its breaking point, the tools that previously stabilized markets have been exhausted. The traditional levers of the Federal Reserve have diminishing returns. Every decision now carries enormous risk because the wrong move could accelerate the collapse instead of slowing it. Meanwhile, public awareness is still low. People see rising prices, maybe hear about layoffs, and assume it's another ordinary recession. They don't see the multiple crises compounding invisibly behind the scenes. That's why panic could spread faster than the system can respond. When confidence disappears, the collapse moves from theoretical to real almost overnight. So what could this look like in practice? Banks might fail. Stock markets could plunge violently. Currency valuations might swing unpredictably. Essential goods could spike in price or become unavailable. Governments overwhelmed may attempt emergency measures that fail to restore stability. And because these events are simultaneous, there's no clear path to recovery. It's not a single crash. It's a chain reaction hitting every corner of the economy. And here's the chilling truth. Even if the Federal Reserve acts decisively, actions could only delay the inevitable, not prevent it. The system is under too much strain. Traditional policy tools work best when problems are isolated, when multiple crises collide. These tools lose their effectiveness. Printing money might ignite hyperinflation, while raising rates might destroy borrowing-dependent industries. Doing nothing might trigger total financial panic. There's no safe option left. March 2026 could mark the moment when the fragile balance of global finance finally tips. Not just a market correction or a recession. It's a systemic collapse, a moment where everything the economy depends on is tested simultaneously. And ordinary people, unprepared and unaware, are the most vulnerable. By the time the warning signs are undeniable to the public, much of the damage will already be done. Jobs, savings, and investments could be lost. Markets will be volatile. Governments may scramble to respond. But the window of control may have already closed. The lesson is clear. The coming collapse is not about a single failing sector or a single policy misstep. It's about a convergence of crises, a system stretched too thin, and a loss of confidence that no institution can immediately repair. For those paying attention, the question is not if it will happen, but how quickly it will unfold, and who will be prepared when it does. The time to understand, to watch, and to act is now. Because once the final trigger hits, there may be no going back. This isn't a warning for tomorrow. The cracks are already here, and the system is more fragile than it's ever been. Debt, trade, currency, and trust, all converging at the same time. And the Federal Reserve may have already run out of options. What happens next could change the economy forever, and those who don't prepare could face the worst consequences. If you found this video eye-opening, hit that like button, subscribe, turn on notifications because we'll continue tracking every development as it unfolds. And let me know in the comments, how prepared do you feel for what's coming?